Good afternoon, everyone. Thanks for joining, and it's always a pleasure to address our partners. What I'll do is, before I hand it over to Akash, just spend 5-10 minutes on the current market situation, the current global and local macroeconomic situation, and then, of course, we will talk about our funds. I'll just share my screen. Meena, is the screen visible?
Yes, sir. If you can just make it full screen, it's visible. Perfect, sir.
Okay. So, as we stand, things are at a very interesting juncture globally. We know that the US economy has been doing extremely well over the last 4-5 years post-COVID, and that's because of the massive macroeconomic stimulus in terms of fiscal stimulus as well as monetary stimulus that the US Federal Reserve and the US government did post-COVID. So, there has been a lot of money printing, a lot of debt issuances, a lot of fiscal deficits, which happened in the US and, of course, in the rest of the world because of that. But the thing is that all good things come to an end. So we really had a fiscal and monetary party over the last 4-5 years. But that has had its side effects of higher inflation. And today, apart from inflation, we are also talking about a recession because now we are beginning to see the impact of that huge monetary and fiscal stimulus getting gradually unwound, or the expectations of unwinding of that itself is causing a lot of volatility in the global markets. So the situation has been, I would say, amplified by Mr. Trump, the President Trump, on his attitude towards tariffs, what he wants to do with Make in America, what he wants to do to global trade. So a lot of loose ends and a lot of open questions currently remain in the global markets, and that's the reason why we see a lot of volatility in the global equity and bond markets. So the current debate is whether the US will go for a soft landing or it may be a very hard recession based on how the customers are reacting, how corporates are reacting to President Trump's steps. And the US currency and bond markets are volatile because of that. And those markets are then influencing the global markets, including markets like India. So I'll just spend a little bit of time trying to view the correlation between the US currency and bond markets and how it is influencing markets like India. Because the main impact, of course, is in FII flows, but ultimately it will also have an impact on the trade flows and the. I will also talk about what the Indian situation is, how the government slowed down spending in the election year, why there was liquidity tightness, etc. So to start with the US economy, the main event I think that's driven the markets in the last few months is basically the strength of the US dollar. So if you see the blue chart, that is the US dollar versus the other global currencies, the US dollar really has been, strengthening sharply since September. And it is no coincidence that September is the month from which we started seeing massive FII selling in India. And not only in India, but in most global markets, we saw selling by foreigners in equities and bonds. And that money was basically going back to the US because of a strong dollar. So this massive, rally in the dollar basically caused the FII flows to reverse. The other thing, if we step back a few months ago, what also has happened in the global markets, especially the US markets, is also something quite unique, I would say. It's quite unique, I would say. So if you remember, in 2022, which is 2 years after COVID struck, we had the Ukraine crisis. The Ukraine war actually started in 2022, and that caused a massive amount of uncertainty in trade. Inflation went up quite a lot. Expectations of inflation went up a lot, and the Federal Reserve, after keeping rates for almost 0%, if you see, this is close to 0.5% interest rates. the Federal Reserve started hiking interest rates. So this pink bar that we see is the Federal Reserve. So they hiked rates, and of course bond yields went up, and you saw that the dollar also kind of was going up and down at that point in time. Then when things started slowing down last year, what we saw that the Federal Reserve cut rates. Normally what happens is when the Federal Reserve hikes rates, the US 10-year bond yield also goes up. So if you see in this situation, the bond yield started going up, and which is how it normally behaves. What happened last year was the Federal Reserve cut rates by almost 1%, but that US 10-year bond yield did not go down, but it actually went up. Okay, and that is what created a lot of surprise in the markets, and that led to the strong dollar rally. Now, why did this happen? Why did the rates go down at the short end, which is the Fed rate policy rate, but the US bond yields went up? How did that happen? Now, that has happened because the bond markets are seeing that the massive stimulus post-COVID, which continued even in 2021, 22, 23, even now fiscal deficit is very high, has led to a lot of extra debt being issued in the last 5 years by the US. And all that debt is now coming for maturity and refinancing in 25, 26, 27, 28, right? So compared to historical times, the amount of debt that is coming for maturity in the next 3-4 years is almost double, than what the markets are used to, which means that even though rates are going down in the short term, the markets are saying that the US will continue to supply bonds at an exponential rate in the future, which means that bond prices will remain subdued. And when bond prices go down, it means that rates are going up. So the US bond rates actually are going up because of fears of continuous large supply to the bond markets by the US in the foreseeable future. Okay, so that is creating havoc in the markets. Now, so that created this huge spike in the dollar as we discussed, right? Now what is happening is everything gets overdone. So even the Trump fear probably is getting overdone, and the US economic indicators are now slowing down much sharper than expected in the last few weeks. So what is happening is that people are saying that this uncertainty created by Trump is scaring the customers, scaring corporates, and the US actually might go into a recession. And recession means that demand will slow down, which means spending, etc., will also come down, which means that you will actually see Fed being forced to cut rates even further. So till about a month ago, the markets were expecting only one cut by the Fed this year. But within 3 weeks, the situation has changed so much that now the markets are expecting 3 rate cuts this year. So it's a massive, fear that is building up that the US is actually going into recession. And that's why you saw the bond yields, the 10-year bond yield, as you can see, the black chart, come down, and even the dollar has started weakening a lot. As we speak, the dollar had moved up from 100 to 110. And from 110, it has almost fallen to 103 today. So it's been a massive reversal. So our logic is why I am positive on India is that the strong dollar caused a lot of outflows from India and emerging markets, and now that is reversing. So hopefully the huge amount of selling that we've been seeing in the global markets is likely to at least reduce, if not stop or reverse. And even if the FIs stop selling and don't buy, that's good enough because the domestic flows are quite strong, as we will see. What is also happening is that the US recession fear is also showing up in other markets like oil. So if you see oil prices also cooling off because if the global economy slows down, then demand for oil will also slow down. And that's the reason why you see even oil having corrected to below $70 a barrel, which is again good for India. So I think the dollar weakening in the last few weeks, the oil weakening in the past few weeks, hopefully FIS selling will stop. And I will talk about the local situation. So I think in net, a lot of the worst case scenarios probably have already been played out. And incrementally, we should see little better conditions than before. The caveat being that the US should slow down and maybe go in for a mild recession, not a huge depression. We are not building in a situation where the US economy crashes, but we are building in a situation where the US economy continues to slow down in a benign way or a normal way. Recession hota hai, it happens 1 quarter, 2 quarters, which is fine. As long as that is the situation, I think things are improving at the flow level as far as India is concerned. In India, 2, 3 things that happened. First of all, last year in 2024, from April to June, July, I think there was no decision making happening at the central government. So there was capital expenditure which was budgeted, but it was not spent. And this is all because of election year situation. The bureaucracy and the government and political system is basically not really focusing on the fiscal or spending, but they were too busy with the election. So the government slowed down spending. Okay. Because of the strong dollar, we also had to keep liquidity tight. So the bond markets were also under stress. Banks were finding it hard to gather deposits because of tight liquidity, and that led to a credit slowdown. It also happened that the RBI got concerned about a lot of unsecured lending growth by NBFCs and banks. So they asked them to also clamp down on unsecured lending, which also led to the slowdown in credit. I think a credit slowdown always leads to slower economic activity, and that's why we saw the economy slowing down cyclically in the past few quarters. The good news is, as I said, a lot of the negatives are reversing. There is no need for extreme liquidity tightness now that the dollar is weakening and rupee is now hopefully stable against the dollar. So liquidity, there is also evidence that the government has started decision making and spending. So they are talking about this quarter being good in terms of government ordering, government releasing payments, etc. So a lot of the negatives in terms of the currency, in terms of liquidity and credit growth, we are already beginning to see some upturn, and we should continue to see at least credit growth accelerate in the next few quarters. So I think the question is now that the markets have corrected the way they are, have they corrected because of a structural problem or cyclical problem? I think the problem was more cyclical in nature. And now cyclical means the cycle can go down and then it turns. So I think we are beginning to see the gradual upturn, and the way the markets have corrected, we think a good base has been formed for the market. Again, on a slightly good news, the government actually came up with the GDP number for the December quarter. So that's on a year-on-year basis looking better than the September quarter, a little bit uptick. And they also revised the GDP estimates for the previous years by a decent amount. So it means that the growth that we saw in the previous years was actually even better than what the situation was. So 23 numbers have been revised upwards, 24 numbers have been revised upwards. The December quarter has been decent in terms of GDP growth on a year-on-year basis, even better than the September quarter. So that's one piece of good news as far as GDP is concerned. As you can see, the government has started spending, and there is evidence. There was a sharp degrowth on a year-on-year basis. This is exactly the time around elections. As you can see, there was degrowth, but now we are beginning to see, and we should see further acceleration of government spending, which should give a good support to the economy. FIIs, as you know, they have been big sellers, and we just described exactly when the dollar started strengthening. We are seeing outflows in a big way, but now with the dollar, kind of stabilizing or even weakening against the global currencies, we hope that the FII selling will also reduce now. The good news is that domestic flows, domestic equity purchases by domestic institutions continues to be quite robust. So even while the FIIs have been selling $5 billion, $10 billion, we have been actually more than compensating for that, which is also the reason why the markets have not corrected as much as they would have in say 5 years ago, 10 years ago. I think there's a huge buffer that is there now in terms of liquidity for the markets. Couple of technical points. Because of the youth selling, the FIIs now are at record underweight positions in India. Part of it may have gone to US, back to US. Part of it probably in the last few months may have gone to China also. But the point is that now they are at the record underweight position. So if India turns around, which I think it will, then the amount of buying that they will have to do just to become neutral to overweight on India can be $25-30 billion. We've seen about $25-30 billion selling in the last few months. And even if that reverses, there is no supply, right? Because domestics have been buying. So all the supply by the FIIs over the last few months has been more than absorbed. And now if they want, on top of that, want to undo that, it will be a huge impact cost for them. Technically, again, markets have been extremely oversold, I would say. This is one interesting indicator. The 200-day moving average is a good support level for most stocks. For the and the out of the 500 stocks in the NSE 500, only 70 stocks are trading above their 200 daily moving average, which means that most of the stocks are so weak that they have broken their 200-day moving average, which is a very strong support. So that's about 14% of stocks trading above their 200 daily moving average. 14% stocks trading below the 200 DMA has happened only maybe 5 or 6 times in the past 20 years. So this is a quite a rare event. It happens only once in 4, 5, 6 years, and this is one of those times where we are at such oversold levels. In fact, in the previous instances. In the previous instances, this has happened only during the global financial crisis. This is when there was a tantrum, and the dollar was strengthening again. Oil went to over $100. Indian currency was weakening in 2013, just before the election. And India was running record trade deficits. The currency was weakening, and globally things were uncertain. And India was considered to be a fragile economy, part of the fragile 5 economies. So that situation only, we were so oversold. This I think is when the demon happened. This is when the big NBFC crisis happened, and there was the SEBI reclassification of mutual funds. So a lot of small cap selling had to be done. So the 2018 panic in small caps, when the small cap index itself went down by almost 50%. And this is the COVID situation, and this is when the Ukraine war broke even. So only very rarely do we see this kind of oversold situation in the market. So with that, you can say that sentiment is already so bad that it can only get better from here. Typically, that's what happens when there is panic in the market. Growth-wise, if you look at the large cap indices, we're expecting about 9-10% growth for the next couple of years. In the small cap index, we are expecting about 17% growth. So the small cap earnings growth is still quite robust compared to the large cap. So when people compare small cap valuations, etc., with large caps, they need to keep in mind the growth, which is almost double that of the large caps. If you look at the PE ratios, corrected quite sharply at very healthy levels, I would say, at this point in time. The large cap index is trading in about 1920 forward basis. Small cap index is around that again, 2021, which is, I think, fair and not too bad considering the situation. In fact, the premium of small caps over large caps has also disappeared. Some people are concerned that small caps have started trading at a premium which is very high, but that has also disappeared. So I think valuation-wise, if you're just for growth and all that, we are in a good situation, and with a cyclical upturn, we do have a liquidity coming back. We do have a situation where we can say that the markets do have scope to go up from this point in time. So that's a bit on the markets and the global and local macroeconomic situation. And Akash, I will request Akash to kind of run us through what we have been doing in our portfolios for the flexi cap fund and the small cap fund.
Thanks, Mihir. I hope I'm audible.
Yes.
I'll just share screen one more. Okay, my screen is visible?
Yes, sir.
Okay, so month-end portfolio for flexi cap. So we closed the month-end with about 863 crore in AUM. First, I'll just take you to how we are positioned across different market caps, and to the right, we have how we are positioned across different sectors. So if you see the left of your screen, as of today, close to 58% of the fund is deployed in large cap, 20% in mid cap, and about 13% in small cap. And vis-a-vis that, we are showing you what is the benchmark. We are somewhat overweight small caps, which is the benchmark, and mid caps as well marginally. As of today, we have about 57 stocks in the portfolio, 27 in large cap, 16 in mid, and 14 in small cap. If you look at the right of your screen, I'll probably walk you through some key sectors where we are significantly overweight. So financial services, about 33% of the allocation. It's about almost 3% overweight, which is the benchmark. Healthcare, about 10.5% allocation, which is about a 4% overweight. And healthcare, we've been running an overweight position in the fund for the last couple of months now. That continues to remain an overweight. The next big allocation is industrials. At one point in time, maybe about 3-4 months back, we used to have significant overweight positions in industrials. But given the backdrop of the cyclical slowdown in the economy, we have sort of reduced somewhat of a position in industrials. And as we see trends changing and positivity emerging around industrials across different subsectors within industrials, be it defense, be it railways, or capex-oriented themes, or manufacturing-oriented themes, we may choose to sort of increase allocations again over there. So as of now, it's somewhat of a neutral position vis-a-vis the benchmark. IT is a marginal overweight at 11.6% versus 10% of the benchmark. So on the top, you see consumer discretionary, which is a mixture of auto exposure, auto anchs. In addition to that, e-commerce, retail, so wide area of sectors within consumer discretionary, somewhat of a neutral weight versus the benchmark. So these are the key sectors where we've allocated the fund. If I show you the top 20 holdings, so if you could just glance, top 20 holdings is 50 or 53.5% of the fund. Some of the well-known common names which feature in the top. And then as you move down the table, some more exposure to mid caps and small caps. The top 10 stocks are about 37%. So we've been running diversified portfolios since we started the fund. So not very top heavy. This is the positioning across the top 10 large caps, followed by mid caps and top 10 small caps. So moving on to the small cap. So we closed the month with about 717 crore in AUM. That's a significant uptick from what the prior month was. We started the fund on about 26th of November. So these are the top 20 holdings, the largest weight being about 3%. The top 8-10 names are fairly equally distributed, I would say. Top 20 stocks are about 45% in weight. So these are the top 10 mid caps, followed by the top 10 small caps. Right. So if you see the left of your screen, the scheme has about 69% allocated towards small cap. SEBI mandates minimum 65%, so we are maintaining about 69%. And there is about 23% exposure towards mid caps. We don't own a single large cap. And we have about 62 stocks in the portfolio as of now. If you see the right of your screen, the key overweights, underweights. So consumer discretionary happens to be the largest allocation, which is almost a 4% overweight, which is the benchmark. If you move down the list, we have financial services, where we've been running somewhat underweight positions for the last couple of months, and it continues to be an underweight. So 16% allocation versus 22% of the benchmark. Healthcare has been an overweight position for us across both the funds for the last few months. It continues to remain 16% allocation, which is about a 3% overweight. And you have industrials, which is turned to be an underweight. This used to be a marginal overweight to neutral position a few months back. So those are the key sectors in small cap. Yeah, I think that's all from my side. I think now we can open up for question and answers.
Thank you, Mihir sir. Thank you, Aakash. I would request participants to please put up the question in Q&A box.
I think we can talk about performance probably, Aakash.
Yeah, let me just put up that slide once again. Right. So this is the FlexiCap fund as of 7th March. Since inception, the returns are for the regular scheme 3.1%, which is about a 4% outperformance to the underlying benchmark. And the median returns in the category is about 3.3%. Sorry, the median returns in the category is negative 0.2. So the outperformance to the median fund happens to be about 3.3% since inception. Happens to be in the top quartile as of now since inception. Coming to the small cap, since inception, we've delivered an alpha of 5.4%. It's been a sort of a volatile patch, so the fund returns are negative. However, we managed to beat the benchmark. And if you look at the median return of the small cap funds, there are 30 funds in the category. That happens to be about almost negative 16%. So there's an outperformance to the median fund performance since inception, and we happen to be in quartile 1. So I think it's a good start for both the funds. Still early days. It's a long journey. So I think I'll leave it there. You want to add a bit, Mihir sir?
No, I think that's good.
Okay.
Thank you, Mihir sir. Thank you, Aakash. We have questions lined up. The first question is, how tariff implication will impact to our market in next 6 months?
Sure, I can take that. See, first of all, India really does not import that many, sensitive or critical items from the US. The largest imports would be stuff like, agri products and some chemicals, electronics, etc. And if we have to kind of bring tariffs down to zero or negligible levels in those items, frankly, I don't think that'll be an issue. Because we still are net exporters in a big way of a lot of other items. We also have to tread with care because while our trade deficit, but trade surplus with the US is there, 50, 60, $70 billion. It is much lesser compared to the services surplus that we have. And one of the big pillars of the Indian economy is IT services. 200 plus billion dollars of exports, out of which bulk of it is going to the US. So we really are dependent on a lot of IT services exports. That's what's keeping the economy afloat for so many years. So beyond the point, we have to tread with care as far as tread with caution as far as negotiating with the US is concerned. So I think it may be a plus and minus across a few sectors, but I think it should not impact the economy in a big way. Frankly, stuff like garments and all. If what garments can we import from the US? It will only be high end stuff, and the value won't be very large. But against that, if we are able to then secure a good deal for exports to US because of mutual understanding, then it's the biggest garment importing market in the world, where we can then be much more competitive compared to Bangladesh, Vietnam, etc. So I think hopefully we should get around it, by promising to import a bit more of defense, etc. I think should be fine.
Thank you, sir. We have another question on, can you please elaborate on Trust Small Cap Fund stock selection criteria?
Sure. Aakash, you want to talk about that? First of all, I would like to say that for FlexiCap fund as well as for the small cap fund, the investment philosophy remains the same, which is growth investing, terminal value investing, growth investing. And in both the cases, we build the portfolio on a real bottom-up basis. And especially in the FlexiCap fund, we don't really take a top-down call on how much should go to large cap, how much should go to mid cap, how much should go to small cap. It's just a stock to stock selection that we do. And the only top-down call typically we would take is for liquidity purposes or for diversification purposes, for risk control purposes. Then we would see sectoral balances, etc. But otherwise, our stock selection, is really, and the portfolio construction is really bottom up in nature. So Akash, you want to talk about how we go about selecting stocks?
Yeah, so taking on from what Mihir sir just said. So during the NFO deck, I think in both the NFOs, flexi cap and small cap, we talked about this LIM framework where we talk about leadership, intangibles, and mega trends. So typically, more often than not, you'll get to see growth stocks in our portfolio, which are run by pretty good quality managements who executed in the past. And they have a fantastic runway for growth over the next maybe 3 to 5 years at least. So that becomes really the harbinger for selecting stocks in our portfolio. And after that, we look at valuations, whether you are paying up for growth or you are paying too little for the kind of growth runway that is there and the execution prowess that the company possesses. So I would say if you go through the earnings growth profile of most of our stocks, and we've been disclosing this, on a need to basis, that most of our stocks, be it flexi cap or small cap, the mid and small cap exposure that we own in these two funds, would be having earnings growth profile much higher than the average stock in the benchmark. So as of today, the EPS CAGR in both of our funds, specifically the small cap, is in the 30s, right? So we're looking at companies which can deliver year in, year out this kind of performance. And 30, it just happens to be the portfolio is delivering 30, but we don't have a benchmark where there should be 25, 30%. We're going sector by sector and looking at growth runway of different sectors. And within that, we identify the best pedigree, the best quality managements to back. So that really is the mantra for selecting stocks in both our funds, not only small cap.
There's a question in continuation to the small cap fund. Small cap fund portfolio has few unknown name companies. What's the rationale behind selecting them?
Well, the more the unknown, the better it is for investors like you, because obviously they're not discovered. Not a lot of people know of it, and we are hopefully, the first few funds or the first few institutional investors in these names. The rationale is pretty much the same what I just mentioned, some time back. We're looking at growth quality of these companies, and if it is unknown, then you can get a fillip in terms of valuation re-rating. And you look at most multi-baggers over the last 5, 10, 15, 20 years, a lot of the returns come because of PE multiple re-rating. Typically, when an unknown name or a skeptical sort of a business model continues to deliver, then, in years to come, then people sort of re-rate the PE multiple of the stock many-fold. So we hope that some of these investments, which are relatively lesser known, they go through that similar journey in years to come.
We have another question on what is your outlook for gold and silver going forward?
Gold and silver, I would be positive because my default assumption is that we just discussed how the US will have to keep on issuing a lot of debt in the future, refinancing a lot of debt in the future. And while they may want to really go about the austerity route, I don't think they have the capacity or the structural strength to go for a hard landing, because that's another way to solve the debt issue. So I think by default they will basically have to by willy-nilly go back to money printing only to print their way out of their debt issues, and that basically means that when there is excess money supply, gold and silver and precious metals and a lot of other assets will do well, including some of the real estate, etc. So I think gold structurally is still a positive story.
Thank you, sir. Another question is, will FII will take out more from here due to tariff?
Not really due to tariff, because again, even when it comes to tariff, as I said, it will be more competitive. So will India be worse off than China or Vietnam or Bangladesh? I don't think so. I think for FIIs, the biggest factor to look forward is the dollar strength or dollar weakness, which is what we just discussed.
Thank you, sir. Mr. Nishant says, congratulations on the huge jump in AUM in small cap category. So the question is, on an average, how much money does the fund get on daily basis, and does it have any high impact cost?
No, we are still not that big to have a high impact cost, frankly.
He has another question is, a lot of multi-baggers would come from the microcap space beyond small cap 250. How do we intend capturing those and covering more and more stocks in that universe?
So we are, as I said, we are quite small now, and I think the previous question also alluded to the fact that we have some not so very well known names which are not very widely owned by other funds, and that's only because of the fact that we are able to, because of our size, go into smaller stocks also. So while typically we are looking at stocks which are more than 5,000 crores in market cap, but if we really find some good valuations and good growth in the smaller ones, we have stocks which have a market cap of 2,000 crores also.
Thank you, sir. There's a question. Last year it was capital gains harvesting. This year it is a loss harvesting. Why mutual funds are always made scapegoats for the benefit of tax evaders?
I'll let that pass.
Okay. Your fund house view on 10-year GSEC by December 25 and US dollar versus Indian rupee view by December 25.
So GSEC yields, we expect them to be within a band of about 6.10 to 6.7. That's the broad range we are looking at for this year. Structurally, I think they should go down from the current levels of around 6.3, 6.25. So maybe 10, 20 basis points down. But given the volatility in the market, I would say not too much more down. So that's the broad direction we're looking at. We're looking at least 2 rate cuts by the RBI in this year.
There's a question. Can you please tell us more about your team construct and how Trust as an AMC monitors its fund performance? This means, what are your parameters to evaluate your own funds?
So it's very clear. We're looking at, of course, right now we don't have a 3-year track record, but 1 year and 3-year track record performance versus the benchmark and versus the peer group is typically what we would be looking at. In terms of team size, we have total across equity and fixed income, we have 12 people as of now, which includes analysts, fund managers, and traders.
There's a question. Can you please justify that TRUSTMF is beating other peers in flexi-cap and small-cap funds?
Is there a question or a statement?
It's a question, justification.
Okay, yeah, no, we are doing okay, I think. Typically, I would want to beat the benchmark by about 4%. That should be, the ideal situation over a long period of time. If I can beat the benchmark by about 4% over a long period of time, that's a good achievement.
Thank you, sir. We have no further questions. I would request participants, if you have any further questions, please put it in the Q&A session. Okay. Okay, I'll address this. Sir, please address one branch office at Vijayawada, Amravati. Help us more funds input. Is there any idea? We are in the mode of expansion, sir. We'll definitely have more branches. We'll keep you posted about the developments on that.
Which is the nearest branch?
Vijayawada and Amravati, I believe.
Hyderabad only?
Hyderabad, Amravati.
No, that is
Hyderabad.
Andhra Pradesh. Hyderabad.
Yeah, Hyderabad. Whether TRUSTMF is on number 1 in all quartiles.
I mean, it's a very short period of time, but yes.
One year, 3-year returns versus benchmark or peers would be the outcome of the performance of these schemes. What are the parameters to evaluate a fund performance well in advance?
We don't know what's going to work, right? Whether value will work or growth will work. But I think in general, our style of growth at reasonable valuations is well suited across cycles. I don't think it leads us to extreme outcomes where we would have one extremely good year and then one extremely bad year. I hope that our style is a little bit more in the middle.
Okay. Right valuation for small cap and mid cap index in current markets.
Sorry, right?
Valuation for small cap and mid caps index.
So as I said, the valuation on PE basis for the mid cap and the small cap index and the large cap index are broadly similar. But the earnings growth for the small cap index is much more than the earnings growth in the large cap index. So I would say that adjusted for growth, the small caps are actually more reasonably valued compared to the large caps. So large caps will be less volatile and they'll give you less fluctuations. But I think if you were to look at the next 3 to 5 years, the growth story in small caps is still more exciting.
So, how many more days this bloodbath may continue?
I'm hoping it's done. But yeah, as I said, no, the US will drive the markets in the short term. But in the last couple of days, we've already seen reduction in the FII selling. Yesterday was only 500 crores, which is nothing compared to what they've been doing so far. So I think that the fact that the dollar is now down from 110 to almost 103 is already playing its role in the overall flows. So we hope that things will stabilize soon.
Any new NFOs coming?
Nothing in the immediate future, I think.
Okay. By when can you expect the sentiment to become positive for investments, and going up, should we go for lump sum or do STP?
So when we launched the two NFOs, we were encouraging more of SIP and STP. But given the sharp correction in the markets, I would say that you can look at a combination of lump sum as well as systematic.
Okay. Can we recommend our FlexiCap for 3 years SIP in equity funds and lump sum both?
Certainly. So as I said, no, you can look at least 25 to 50% lump sum and balance you can time it out.
What is your view for India GDP in next 2 years?
About 6.5 to 7 is the aspiration. I think 6.5 is more doable. 7.5 will be a positive outcome if they manage that.
How do we approach to deploy lump sum amounts currently?
As I said, earlier we were saying that we are encouraging more of systematic STPs or SIPs. But after this correction, I think half of it can be put into lump sum and then you can stagger the balance.
Okay. We don't have any further questions. I will just request one more time, and if there are no further questions, we can then conclude the session. So before we end the session, would request participants, if you have any further questions, please put it in Q&A box.
On the question on sentiment, on a lighter note, sentiment is a function of the market rather than the other way around. So if the market goes up for 3 days, sentiment will come back.
True. So we have one last question, which says last 2 quarters company revenue growth was slowed down. How long will it continue?
So as I said, the factors driving the slowdown were government spending, tight liquidity, credit growth slowdown, unsecured loans. I think all those factors are now coming, back and becoming positive. So I would say that turnover growth should also now follow. There is some anecdotal evidence that the Kumbh Mela itself has created a lot of GDP. I mean, on a serious note, at least in the UP, you can see some impact. So those kind of small things can actually show and add up and lead to the cyclical recovery. And government has also started spending.
Sir, somebody wants to know what exactly terminal value investing is.
Okay, so it's a long session, but I'll try to explain in 5 lines. Terminal value investing basically applies to high growth stocks and sectors, and the philosophy or the mathematics behind it is that for high growth stocks and sectors which are expected to grow for long periods of time, the near term profit growth is not that important. So even if you find a stock and you're excited by saying that it's going to grow at 30-40% for the next 2-3 years, it is more important to take a call on how long this growth phase will last. So between a stock which will grow at 30-40% for the next 3-4 years compared to a stock which is going to grow at 17% but for 10-15 years, the markets will give much more valuation to the second stock. So the valuation is basically determined in high growth stocks and sectors by the length of the runway of growth and the the valuation that the market gives to the near-term profits compared to the valuation that the market gives to the longer-term profits is skewed 70-80% in favor of the long-term profit growth. And this is the terminal value. So value of the profits beyond the immediate 5-7 years is called the terminal value. And stocks which are, in a high growth phase have very high terminal value, which means that if you look at the current market cap, only 20% or 30% of the market cap will be attributed to the next few years. So you will see that but 80% or 70% is coming from the back end profit. So on a current PE basis, the stock will look very expensive to you. But that is because 70-80% of the value is coming not from the immediate profits. So this terminal value, or to get a hang of what the terminal value can be, is basically very important for high growth stocks and sectors. And this is what we call terminal value investing.
So there's a question, IT stocks growth in next 3 to 5 years, any impact due to Trump tariff issues?
IT services, I think not. But in general, the large cap IT stocks will grow at single digits. So in IT, the fun is more in the mid caps, frankly speaking.
How do we go beyond the projections given by the corporates?
So the corporates don't give projections beyond 1 year, 2 years, or 3 years maximum, guidance or projections or whatever you call it. So beyond that, it's basically a calculated judgment, taking into account the prospects of the company, the prospects of the sector, the prospects of the economy, whether the sector is a mature sector or a emerging sector or a growth sector, all those things basically, and whether and of course the framework that Aakash mentioned, leadership intangibles and megatrends. That framework basically helps us to figure out the longer term growth prospects of the company.
There's a question, Mr. Shankar Sharma says no upside in Nifty for 5 years. What do you say?
The market is there because there are two views always, Otherwise, there won't be otherwise there will only be buyers and only be sellers. But there are buyers and sellers. So there are obviously different views in the market.
I think we have no further questions, sir. So I would thank everyone for joining us today for this session. Thank you, Mihir sir. Thank you, Aakash. Thank you everyone for joining us today. Thank you.
Thank you, everybody.
Okay, thank you. Bye.